There are few things more frustrating for a trader than when he gets up big money on a trade only to see those profits dwindle to zero or even turn negative. I'm Seth Freiberg, the head trader of SMB Capital's options trading desk here in Manhattan, and the professional traders on our desk are trained to learn how to pull the risk out of trades at the earliest possible stages, putting those traders into the driver's seat. If this frustration of watching your profits vaporize sounds familiar, then stick around because I think you're going to find this lesson intriguing. Hi, I'm Seth Freiberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, since the COVID-19 crash in March of this year, we've seen one of the most breathtaking market recoveries in history, and that recovery was felt no more intensely than on the NDX index, the Nasdaq 100 index, which is a basket of stocks which includes most of the major tech names like Apple, Alphabet, Amazon, Microsoft, Facebook, even Tesla, just to name a few. Now, when an index or any other asset, for that matter, absorbs this kind of momentum, traders and investors are sitting on huge unrealized gains. And in those cases, many traders and investors turn to index options in order to make money on a pullback, which makes it easier for them to ride out a pullback and not sell those shares, taking an unwanted huge capital gain in the process. Now, before we get into a recent example of how this could have been accomplished, we need to make sure that everyone watching the video understands how index put options work. Hang in there if you already know this stuff. I'll be quick and then we'll jump back into the lesson. Okay, so now almost all of you are probably familiar with equity options, where a call buys you the right to buy 100 shares of a stock at the strike price of that option anytime before the option expires, and a put option entitles you to sell 100 shares at the strike price of the put before that option expires. But there are also index options, which work similarly to equity options, except there's no such thing as 100 shares of an index like the NDX index. You can't really buy or sell 100 shares of the NDX index, but what you can do is get paid in cash, $100 per point, if the index expires above the strike price of an index call that you buy, or alternatively, you'd be paid $100 per point for each point the index drops below the strike price of your index put. So focusing exclusively on how index puts work, let's say that the NDX is trading at 9,000 and you buy an 89.75 put, 25 points lower than market. If the index sells off to 89.65, you'd make $1,000, as you can see from the calculation. But if the market just sold off to 89.75 or higher, the put would expire worthless. So those are the basics of index options. And remember, you can buy options, but your broker will allow you to sell options as well. And your broker will allow you to put together combinations of options. In other words, options strategies that involve both short and long options purchased in a way that's advantageous to you as a trader. Okay, so let's say that on August 26th, with the NDX trading at 11,943, you decide that it's time for the market to take a breather and book some profits. After all, the index is up almost 5,000 points from its March crash lows and way past its all-time highs from prior to that. And so it's pretty logical to think that the market might take some profits in here somewhere. Of course, you can't know that for sure, but let's say that you're willing to take a shot that by September 18th at the latest, the NDX would sell off and you'd make a profit on that put. So let's say on that day you bought the 11,925 put, which was 18 points below where the market was trading. That cost you, as you can see, $289.40, which, remember, represents $100 per point, so the total cost outlay would actually be $28,940. Now, before we get into how we're going to trade this put strategy from here, I wanted to let you know that there are lots of sound, viable long-term techniques for trading options for income. And in fact, we're currently running a 2-hour free intensive workshop at the moment where we'll be teaching you 3 of those strategies that real professional options traders use, including a really simple but incredibly effective strategy that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like where you'll make your target profit, whether the stock goes up, goes nowhere, or even goes down a small percentage. And if those strategies would be of interest to you, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That's going to open up a free registration page in the new window, so don't worry, you won't lose this video. Or you could just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Let's move forward now to September 2nd. And as you can see, the NDX index has moved up further to the 12.4 level and almost a 500-point rally since we put the trade on. And as you can see, we've drawn down quite a bit, more than $13,000, and that is the kind of risk we're taking here, but the trade's still active. Now let's move forward to September 4th, a few days later, and as you can see, well, the NDX index has now sold off substantially, down to 11,472, almost a 1,000-point drop from the peak. And now that put that you bought, that 11,925 put, that's close to 500 points in the money, and so naturally it will have increased greatly in value. Now, here's where it gets interesting. Let's say on that day you decided that while you thought the NDX would sell off further, if it bounced, your put would lose much of it, if not all of its value. So at this point, experienced options traders might modify the trade into what is known as a debit spread, selling the 11,700 put for 479.15, which brings in $47,915 in cash into the trade. Now, this is an incredibly significant move. Let's take a look at the cash flow of the situation so you can understand why. You see, when we first entered the trade, we paid almost $29,000 for the 11,925 put, but now that the market has sold off, driving up the value of the 11.7 put hugely, because it's what options traders call an in-the-money option by about 228 points, meaning in the case of a put, that if the option expired today, that option would pay off because the market price is below the strike price, whereas the original put that we bought had a strike price that was below where the index was trading, and so it would have no value if that option had expired the day we bought it. So that difference has a big effect on the value of the option. As you can see, it had such an impact because it was so far in the money that the put option we sold actually had a greater value than the one we originally bought, creating positive cash flow of $18,975. Now, why is this so crucial? Well, think about it. Let's say that the NDX index bounced from here, and on September 18th, when these options expire, NDX has rallied back to, say, 12,000. Well, what would each option settle for? Well, as you can see, both put options would expire worthless as they're now out of the money on expiration day. So what that means is that the net cash flow of the long put and the short put, that positive cash flow, is our profit on the trade because the options have died and gone to options heaven. And in fact, that's true at any price above 11,925, as no matter how high the NDX closes on expiration day, both options will expire below the market and therefore worthless. But let's consider another scenario. Let's say that the market closes at 11.6 on September 18th, having sold off another 100 points. Now let's analyze that situation. Well, in that scenario, the 11.9 put, that would be worth $30,000, as you can see from this calculations, because it's 300 points in the money. But on the other hand, the 11.700 put, we are short that option. Well, we're obligated to pay the put owner $10,000 because that one is 100 points in the money and we're short that. So when you add that to the original cash flow of the components of the debit spread, you can see that the final outcome is a profit over $40,000. But if you think about it, at any price below 11.7, the profit would be that same 41,475. Why? Well, let's say that the NDX index had started to crash again, and by September 18th, it closed at 9,000. Well, let's do that same cash flow analysis. And as you can see, the long put blew up in value even more, but so did the short put. And so the difference between them remains exactly the same regardless of how low the index drops. So if you think about what we've been saying here, if NDX closes above 11,925 on the upside, then we're guaranteed 18,975 as the original cash flow. At any price below 11.7, the short put location, we max out at a gain of 41,475. At any price between 11,925 and 11.7, we get our original cash flow plus the value of that in the money 11,925 put, which is naturally going to be a larger and larger profit as the price goes further south towards the 11.7 put until the full profit level of 41,475 is reached. This situation is graphically depicted by most brokers' options analytical software like this, incidentally, showing you clearly that the trade has no risk once that short put is sold in this trade for an amount greater than the cost of the long put originally. So if you think about it, once we were able to sell that put lower on the options chain for a greater price than we paid for the original put, we guaranteed our profit to be a minimum of the net cash flow of the two options taken together. So what I'd like you to take away from today's video is that if you're able to be patient and wait for a market reversal on a single long put or call, for that matter, you can get yourself into a position where you have taken all of the risk out of the trade by guaranteeing a profit whether your options expire worthless or expire with some value. Once you achieve positive cash flow in this manner, now you're in the driver's seat. You can elect to stay in the trade and potentially make more money, as we explained, while having the knowledge that you've locked in at least a terrific gain regardless. It's a nice feeling to have that trailing stop put in on the trade once you understand how to buy and sell options strategically. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it and would like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open up the free registration page in a new window, so you won't lose this video, don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And please don't forget to click on the subscribe button right now so you won't miss all of the free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader.